Okay, thank you for joining the second CEPR Rising Asia workshop. My name is Kenichi Ueda, teaching at the University of Tokyo. This series is conceived by the leadership of Keith Kojak of Utrecht University, who is participating today online from the Netherlands briefly at the morning session and fully as a chair at the afternoon session. This workshop series, which we hope to continue, focus on Asia, but not on major countries like China, Korea, Japan, Singapore usually. Therefore, submitted papers mostly about cross-country studies, including Asia. There are a few country-specific studies which I would like to see more in the future. We are recording the video and chat, which will be published on the UTokyo CAF website and CEPR website later. If you have any problems with it, please let us know by email by the end of this weekend. For each paper, the presenter has 25 minutes to present and discussant has 15 minutes. Then there will be 10 minutes of open floor discussion. Those who would like to ask questions, please wait until the open floor discussion starts, unless it's a clarification questions. And for those participating via Zoom, please indicate by clicking the raise hand command in Zoom. Of course, you can always write your questions and comment in chat. Co-authors may answer you in chat during the presentation. The morning session is about capital growth, and the afternoon session is about ESG investments and climate change. I think we can, a little bit early, but we can start. Let's begin with the talk by Mr. Umang Rawat of the IMF, titled "Do Capital Controls Limit Inflow Surges?" Umang is here, or maybe not here yet.
Hi, I'm here. Can you hear me? Hello.
Author, or you are the Umang?
Yeah, sorry, I logged in from my wife's computer, so I don't have Zoom installed on my laptop.
I see. That's why you...
it shows up as her name. Sorry, I just realized.
I will give you wait a second. I will give you co-host status right now.
Okay.
And you can share screen. You can share your
yeah, I'm sharing now. Can you see?
Yes, I can see.
Okay, perfect. So let me know whenever.
Yeah, that's fine. But just for us in here, これを僕の画面にも映ってるんだけど、それが、yeah, that's right. That's good. And also, Umang, can you somehow make it bigger? Or this is a big, largest? Oh, that's maybe too big.
Is this okay?
No, it's kind of strange. Yeah, I think that's fine. That's fine. Okay. This is probably the limit we can do. Okay. Please go ahead.
Okay. First of all, yeah, thank you so much for having me.
Just wait for the floors here.
Sure.
Please, Martin, pick up your voice and also following wherever you speak. This camera follows you. So then speak loudly in the floor. Okay, go ahead.
Okay. Yeah. Thank you so much for having me. So today I'll be presenting this paper, which is called "Doing Capital Controls Limit Inflow Surges," and this is joint work with colleagues in the IMF with Apoorv, Bhargava, Bouis, Annamaria, Kokenyne, Manuel, Perez, and Ratna, Sahay. So let me start with the background, motivation, and research questions. So capital flow surges and reversals, they've long been a concern for policymakers, particularly in emerging market and developing economies, and countries have followed different approaches to handle capital flow volatility, reflecting country-specific characteristics. And one such tool to manage capital flows, which is arguably the most controversial one, is the use of capital controls. So the current paper, it contributes to the large and growing literature on the use and effectiveness of capital controls by addressing three main questions. The first question, whether do countries respond to inflow surges by introducing or tightening previously existing capital controls, has been subject to much debate. The literature has found mixed evidence as far as this question is concerned. While there's a large body of work that finds that capital controls are largely acyclical and do not respond to macroeconomic fluctuations, a different strand has found that countries do react to economic conditions by introducing capital controls in a countercyclical manner. In this paper, we find that capital controls are used during and around inflow surges. However, at the same time, we also find that capital controls, in fact, a lot of them are also tightened outside of these surge episodes. The second question is about the effectiveness of capital controls. And again, there's a long history of literature in terms of effectiveness, where effectiveness has been measured by various objectives ranging from reducing the volume of net flows to altering the composition of flows to alleviating exchange rate pressures and or making monetary policy more independent. In this paper, we assess effectiveness by the ability of capital controls to be able to reduce the probability of future surges. And we find that tightenings, they do actually limit future surges, both at aggregate and at asset-specific level. And the third question that we look at is one of multilateral spillovers, which is, is there an impact of imposition of control to other countries? So the empirical evidence on this is currently limited, and we do find evidence of multilateral spillovers, and we find that capital control actions, they result in flows being deflected to other countries in the region with similar fundamentals. So now let's move on to the data and the descriptive statistics. So in terms of the data, we look at effectiveness of capital controls using a sample of 40 advanced and emerging market economies. However, the EMDs basically dominate the sample, and the time period is quarterly data from 1995 to 2018. Two things to highlight in terms of data, just in terms of the definitions. For capital flows, we use gross private non-resident inflows, which is the difference between non-resident inflows and non-resident outflows. And in terms of capital controls, if we sort of look at the literature, the vast majority of the literature, it looks at the effects of capital controls using annual indices on the level of capital controls. And these indices, they somewhat capture the extensive margin of controls, which basically, it tells us how many transactions in the BOP they are regulated. But it doesn't tell us a lot about the intensive margin in terms of how do these restrictions change over time. For example, if non-residents' purchase of debt securities is regulated in a country, the presence of this control would be coded as one in most of these annual indices. However, any further tightening of that control will not be reflected in extensive margin-based annual indices. A recent literature of work has sort of looked at capital control changes in trying to sort of more capture the intensive margin. So in this paper, we follow a narrative approach where we sort of look at the changes section of the area database to identify changes in policy regulations. And each policy action has a unique classification along the following dimension. The first is the direction of flows. So for our analysis, we focus on controls on resident liabilities, which is non-resident inflows, and their repayments, which is on non-resident outflows. Direction of change, whether it's a tightening or an easing of regulations. And for this paper, we mostly focus on tightening measures outside of crisis events. So capital control tightenings on non-resident outflows during crisis events are predominantly done to prevent outflows with immediate effect rather than preemptively discourage inflows. And so in that sense, including these measures would introduce noise in the sample. The third dimension is one of asset classes. So we look at 4 asset classes: equity, debt, FDI, and other flows. And the other flows basically consist of commercial and financial credit, so the bank flows generally. And finally is the type of instruments, whether the regulation is, or the control is quantitative in nature or price-based or administrative. So overall, we end up with 184 measures identified across these 4 asset classes. So this slide here just provides some descriptive statistics on the controls. So the tightenings of capital controls on non-residents, they have progressively increased from the early 2000s, as we can see in the left-hand panel. And it has remained high in the post-GFC period as ultra-accommodative monetary policies conducted in core economies and the associated rise in global liquidity have put pressure on emerging markets. In the right-hand side, we see that not surprisingly, a bulk of these capital controls have been introduced by emerging market economies, particularly in Asia and in Latin America. Although some European countries like Iceland and Ukraine have also actively used controls. Moving on, in this slide, we see that the tightening of capital controls is evenly distributed across the 4 asset classes that we look at. There's a slightly more number of controls in the bank flows and in debt category, but overall the distribution looks uniform. And on the right-hand side, we see that about 1/3 of the tightening of capital control is price-based measures, which is taxes or unremunerated reserve requirements, while administrative measures, limits, registration and mandatory holding account for about 10 to 15% of the measures each. The other issue in terms of data is one of how you identify surges. So there's no single agreed way or methodology in the literature in terms of defining how to identify inflow surges. So in this paper, we look at 3 different ways of defining surges for robustness. The first one is the one based on Forbes and Warnock definition, and there they define surges when 3 conditions are met. First, that the year-on-year changes in the 4-quarter gross capital inflows should be greater than the historical average by more than 2 standard deviation. The second is that the surge episode, it lasts for all consecutive quarters for which the year-on-year change in capital flows is greater than the historical average by 1 standard deviation. And the third is that the length of episode should be greater than at least 1 quarter. The second definition that we use is the one from Ghosh et al.'s paper from 2014. And they basically have a time as well as a cross-section dimension of surges. So in their approach, a surge is defined when a particular capital flow observation lies in the top 30th percentile of both the country-specific as well as the full distribution of capital flow. So also taking into account country's history, but also in terms of just the volume, looking into the cross-section element as well. And the third measure that we use is a simple threshold-based measure where we say that a particular country is said to experience a surge if gross total non-resident inflows exceeds 5% of GDP. This chart here shows the distribution of the 3 of surges based on the 3 measures. It shows a percentage of sample countries experiencing a surge using the 3 methodologies that I talked about. While the correlation between these 3 surge methods or surges identified by 3 methods is not that high, just sort of eyeballing the chart shows that they do follow a similar trend nonetheless. So with that, we can move on to the 3 questions that I mentioned in the beginning of the presentation. The first question was about the timing of the introduction or tightening of the capital controls. So the 2012 institutional view on the liberalization and management of capital flows by the IMF, it proposed that CFM or the capital flow management measures, they may be introduced when a country experiences a surge. So if countries were to follow the IV, one would expect that capital control tightenings should be clustered around the identified surge episodes. However, the other thing to point is that the recent revision of the institutional view has proposed that CFMs can additionally be appropriate outside surges if there are high stock vulnerabilities. So the chart here then shows the distribution of tightening of capital control measures with respect to the surge episodes. And here we use the Forbes definition as the baseline case. So on the left-hand side, at 0, you have the incidence of surge, and then you have quarters after surge and the number of tightenings that happen. And on the right-hand side, you have the mirror image where you have the controls being introduced or tightened number before the surge and the number of quarters there. So as sort of mentioned by the 2012 IV, we do see some clustering of tightenings around the surge episode. So basically that's around the 0 number on the x-axis, but at the same time we also see a large number of other tightenings which are unrelated to observed surge episodes, which basically would say that yes, countries are tightening around surges, but that's not the only time when they are tightening, and there seems to be other episodes where countries have employed tightenings of capital control. The second question then is about whether or not capital control tightening is effective in limiting surges. And to answer this question, we estimate a fixed effects logit model where the dependent variable is a binary variable, indicating whether or not a country is experiencing an inflow surge in a particular quarter. And on the right-hand side, we have this control variable, which captures whether a country has introduced a capital control in the past 4 quarters. And in additional specifications, we also replace with this indicator control variable with the actual number of tightenings, as well as introducing both number of tightenings and number of easings in the specification. Other control variables include some domestic pull factors, so the GDP growth and interest rate differential from the US, country-specific risk indicators, as well as a stock of FX reserves and a lagged restriction, capital account restrictiveness index based on Fernandez et al. And in addition, we also introduce country and time fixed effects. So this slide here shows the results from this exercise. And if we look at the first row, which is basically whether tightening in the past 4 quarters, which is basically an indicator variable, it's 1 if there has been a tightening. And we see that there is a negative and significant impact on, at least based on 2 surge definitions. If we look at the bottom 3 rows, there you have the sum of net tightening, sum of tightenings, and sum of easings. And there we see, specifically, if we look at the sum of tightenings in the past 4 quarters, we see that based on all 3 definitions of surges, tightenings in the past 4 quarters do reduce the probability of future surge. So there is, of course, a little bit more information in the sum of tightenings than in whether or not there has been tightenings. And if there are more number of tightenings, this variable would increase, the number would increase. But at the same time, I think one has to, one of the caveat here is that if you have 5 tightenings in the past 4 quarters, that doesn't necessarily mean that the restrictiveness, is stronger than if you just have 1 tightening, because all that we are measuring here is the changes in regulations which move towards tightening, but the intensity of those changes is not something that we are recording here. So I think this is something that most studies in the literature suffer from, and is something that is an area of future research to also look at how to appropriately capture not just the existence of tightening, but also the quantitative or the intensity of that tightening measure. So the last slide, there we looked at surges at the total flow level, and the control variable was 1 if a control has been introduced in any asset class in the country. So there are 2 potential concerns with conducting analysis at the aggregate flow level. 1, that surges could be asset specific. For example, there's a possibility that there's a surge in a particular asset class, but not a surge in the aggregate flow level in the country. And second, when you're conducting analysis at the aggregate flow level, you can't necessarily map the controls to the asset class that it's applied to. So in the next stage in here, we basically look at a 3-dimensional country time asset panel, and the inflow surge here is basically surge at the asset level, and the control asset is then controls directly applied to the particular asset that it's targeting. And other than that, you have similar control variables in the specification as well. So moving on to the results from asset level regressions, we find that the results are more significant here, and capital controls are found to be effective in reducing probability of future surges using all the 3 different measures of tightenings that we have, whether we are just using an indicator variable, whether we are using the net tightening, which is tightening minus easing, or when we include tightenings and easings separately as well. Okay, so having sort of found that controls, they can indeed be helpful in limiting inflow surges, the third question that we look at is whether or not there are side effects from introducing these controls in terms of deflection of capital to other countries in response to the imposition of controls. So again, we use a similar specification as before, but we add this additional term. So this is the term with the coefficient beta 2 here, so control S, and which basically captures the impact of controls introduced in other similar countries. The underlying reasoning here is that when controls, they are tightened in a country, investors, they tend to move their capital to other countries with similar fundamentals. And now we use several metrics to group countries into these similar fundamentals bucket. So there are 3 metrics that we use. We use a region-based metrics, a return-based metrics, and a risk-based metrics. So for example, in the region-based metrics, if one country in a region introduces controls, the assumption would be that capital will move out to other countries in that region. And then this control S variable would basically be a flow-weighted average of the controls introduced in all other countries in that region. Similarly, we have a risk and a return-based metric. So for return, we use real GDP as a proxy, and for risk, we have a country risk indicator. So for both these things, we have the distribution, a time-varying distribution of return and risk. And then based on that distribution, we divide our sample into 4 groups, just the 4 quartiles. And then if, say, for instance, if you're looking at the bottom 25th quartile, so the group of 10 countries, if we would see for the regression equation basically would employ all the controls introduced in the other 9 countries in that group, and you weigh it with the flow, that capital flows that go into that countries in constructing this control S variable. And the 4th spillover variable that we consider is this large EME-based spillover variable. And here the assumption is that the most important spillovers from the introduction of capital controls are likely to stem from the BRICS countries. And in particular, BRICS countries, they are assumed to be affected by spillovers of capital control actions in any of the other BRICS, but spillovers to other emerging market economies, they arise only for actions in the regional BRICS. So for example, if we look at Asia, we would say that if there's a capital control action in India, that could have spillovers to all the other BRICS countries. In addition, it could have spillovers to other emerging markets in Asia, so Malaysia, Thailand, Indonesia, etc. So that's the 3rd metric for using spillovers. So this is the results from the multilateral spillover exercise. And we do find significant multilateral spillovers from capital control actions. We find that tightenings of capital controls, it increases the probability of surge in other countries with similar risk index. So that's the risk-based spillover. And so basically within group spillover, when countries are grouped by risk index is high. Similarly, capital control tightening in large emerging market economies. So in the BRICS-based spillover, we find that could increase probability of surges in other countries as well. At the same time, we also find that easing of capital controls can reduce the probability of surges in other countries with similar fundamentals. And here the region-based spillover is what comes out to be significant. So with that, I can conclude. So what we do in this paper, we contribute to the literature by constructing a granular data set on capital control actions in a group of 40 emerging market economies and advanced economies. The literature has defined surges in various ways. So in this paper, we look at several definitions of surges, and we find that, and we use that to assess effectiveness in limiting future surges. In terms of timing of capital control tightening, we find that while they are tightened around surges, there are also several tightenings in periods unrelated to surges. Tightenings, they are found to reduce the probability of inflow surge both at an aggregate level and at asset level, with the results being stronger when controls are directly mapped to the asset class that it's applied to. And finally, while controls, they may limit inflow surges, and hence they could contribute to the domestic stabilization objectives, there are multilateral spillovers in the form of deflection of capital, which may call for international cooperation in the use of this policy. So I'll stop with that. Thank you.
Thank you very much, Umang. And then discussant by Professor Kato, Asia University. Wait a second. Yeah, adjusting Zoom. Okay, good. Please.
Good morning and good evening to the most of the audience outside Japan. Can you hear me clearly, Umang, particularly?
Yes, I can hear you. Thank you.
Thank you for the great presentation. I think it's a very valuable paper. And also I thank Ueda-san for giving me this opportunity to discuss paper. Okay, if the audience is not following this literature very closely, like me, the two slides that I'm going to show you soon. The two slides that I'm going to show you soon may help you share the background of this paper. I just noticed that in fact I'm using 3 slides, including this slide. But let me ask 2 questions. Questions are 2. The first question is, do surges make countries more crisis prone? If every one of us can agree on yes, of course, that's good. But otherwise, it is not clear why they're studying surges instead of sudden stocks or financial crisis directly. The second question is, okay, if inflow surges precede or even predict the financial crisis, then the next question is, why do we need intervention, particularly capital control measures? If you again think, of course, yes, we need capital control measures, that's good. But not everyone is so smart. For example, the fund, IMF, had a different views and policy recommendation regarding capital control measures before 2012. In principle, I think if you want to make a strong case for the intervention, like capital control measures, you have to argue that there are some inefficient boom bust cycle, or if you like to say inefficient surge top cycle, which must be fixed by policy intervention measure. So my sense is that to get fully prepared for this paper, I think we need to go through these two steps beforehand. Here's the first question again. Do surges make countries more crisis prone? The answer is yes. According to, for example, Weinherd and Weinherd, in their 2010 paper, they are saying that the probability of an external debt crisis, currency crash, banking crisis, or whatever defined, probability of financial crisis conditional on the capital flow bonanza, that's their terminology. Conditional on capital flow bonanza is significantly higher. And how much? You can look at the numbers at the bottom of this table. The table is taken from the Reinhardt 2010 paper. So we could say that the probability of financial crisis is how much? Probably 5 to 7% higher if that country experienced surges within 3 years than the unconditional probability. And this difference is statistically significant. Okay, so this is why the authors, including Umang, are studying surge episodes rather than crisis episode directly. So I would say they are preemptive, the preemptive purpose. Okay, next question is, we now know inflow surges precede a crisis. But does it mean that someone needs to intervene in international financial markets to reduce inflow surges? In other words, what kind of inefficiency or market failure do policymakers need to fix? To this question, there are multiple answers from a variety of studies on financial crisis, I believe I know. Here, one influential literature is overborrowing. I'm referring to Bianchi 2011 paper, for example, among many others. Actually, there are many other papers, similar papers, works focusing on the role of so-called pecuniary externalities. Let me briefly explain the common idea of these studies. You can consider a simple, small open economy where the residents are borrowing from abroad, but they're subject to an occasionally binding collateral constraint, a borrowing constraint. And if it binds, it's a crisis. Some other people say current account reversal, whatever. But if the collateral constraint binds, that's a crisis. If that is the case, Bianchi and other other works demonstrated that if the maximum amount that resident can borrow from abroad depends on the value of collateral or asset prices, then that's enough for pecuniary externality to play out, to arise. So the laissez-faire or unintervened market equilibrium is inefficient. Specifically, many studies show that pecuniary externalities result in too high crisis probability to the constraint optimal. So this also means that, yes, we need to fix inefficient boom bust cycle with some policy measures. Let me just add one more point. Although I'm not fully sure that the idea of pecuniary externality is certainly, although I'm not sure fully about the IMF, the funds institutional view papers, but I just guess this idea of pecuniary externality is certainly one of the background of George Fund's institutional view papers published in 2012 and later in 2018. CF made the capital flow management measures. Then, with those two-step preambles, here's what this paper does. Only main issue. So they're making a case for capital control measures to prevent financial crisis because capital controls are effective in reducing inflow surge probability. So I'm sure that the paper is highly valuable because they provide a clear-cut evidence supporting capital control measures, and they do so based on a very recent data set until 2018. So that is the advantage of this paper. In addition, technically, they apply a difference in difference type probability model. So in terms of methodology, this work is based on a solid econometric technique. I have 3 comments. Only on main point that they are making. So the first comment is about endogeneity. This is one of the most frequently asked questions, but I cannot avoid this issue. So they are asking if capital control measures can reduce inflow surge. So because the country introduced the capital control measures, you don't observe not so many surges. This is channel A. Okay, this is what they want to estimate. But the causality can go the other way around. It may be the case because some countries experience some inflow surges. That's why they decided to introduce capital control measures. This is channel B. But in general, G2 are interacting in actual data. Okay. So this is a classic identification problem to separate policy reaction function and the effectiveness of the policy that you're interested in. And the authors, including Umang, are clearly aware of this issue. So that's why Umang mentioned the second point, I think. They examined the timing of the introduction of the capital control measures, and they concluded that the timings are not related to surge experiences. So what they estimated is channel A instead of channel B. Their strategy is sensible. So here my comment is just for reference. There is, just in case, more formal econometric technique known as propensity score matching. Propensity score matching is, briefly speaking, a technique to mock up a kind of randomized control trial. So the authors can apply this method to the case in this paper. If someone is interested in the method, Invens and Udrich provide a practical survey. And here there is Shirota's 2018 paper. Shirota is demonstrating a very nice application of the technique. He basically, what he's doing is to estimate the effect of unconventional monetary policy on stock prices. So there's very similar endogeneity problem in his issue. So the methodology itself can be applied to this to the issue that is handled in this paper. So this is just for your information. The second comment is about regarding how capital outflow promoting measures are considered in this paper. Basically, it looks that they are examining if measures to decrease capital inflow can avoid surging. But in the meantime, there are some policy options, some other policy options, for example, to promote capital outflow during booms and surges. Instead of restricting inflow, but you can let them go out of your country. So it was not fully clear to me how this kind of capital outflow promoting measures are considered in this paper. I noticed that the capital control is counted somehow, included somehow in the estimation regression, but it appeared to be they mean removal of capital inflow restriction rather than outflow promoting measures during improvement. In this regard, I'd like to point out this issue. Many of us are familiar with the context. Traditionally, these capital outflow promoting measures are the primary policy recommendation of the fund, IMF. For example, this is the phrase taken from 2007 GFSR. Let me read here. Loosening or eliminating restriction on residents' capital outflows is a tool that can ease pressure from large capital inflow. It is something that drafted by Ueda-san. No. Okay, even if it's not drafted by Ueda-san, I think it's a sensible policy recommendation. It wasn't, it still is. So I'm just wondering if this kind of policy recommendation is interpreted in your work in this paper. Okay, third comment is minor. The third comment is about how to consider the difference of policy measures in terms of its, according to Rawan's presentation, so it's about intensity. So Rawan made it clear in his presentation in distinguishing intensive and extensive kind of margin. So this is about intensive margin, and he already addressed this issue, or partially addressed this issue in his presentation, but let me just explain. The main explanatory variable of the interest is number of tightening measures. And it was clear that that was included in as a 0-1 binary dummy denoted by control I. So, but I came up with a question. For example, we can consider a case like this. One country lays 1% tax levy on foreign borrowing. In some other case, there's a country which lays 10% tax on foreign borrowing. So should they be counted as the same ones equally? So I'm just wondering how the difference in intensity or strength of each policy measure is being handled in the regression. Rawan has already explained that in the literature, what really matters is extensive margin rather than intensive margin, then that's okay. Let me stop here. Thank you.
Thank you very much, Kato-san. Umang, or if any co-authors joining, do you have any answer to the discussant?
Yeah, no, I would like to thank the discussants. I think these were all great points, and I think these are all issues that we have talked about amongst ourselves as well in the course of writing this paper. And I'd also like to thank the discussant for providing the context. I think he did it better than me to set the stage. But yeah, just to give some sort of views on the three comments particularly. I think on the endogeneity, yeah, this is one of the things that has been often sort of raised in this literature, and there is no clear-cut way of dealing with the issue. But as you mentioned, in this paper, given that we find, and actually I did not show it in the presentation, but when we look at the introduction of tightenings, we also do this econometric test where we try to see, where we compare the actual distribution of introduction of controls with a randomly chosen distribution. If we say that the controls are randomly tightened, and then we don't find those two distributions to be significantly different. So that also provides some credence to what we are showing. The other thing that I would like to highlight is that the reverse causality issue that was highlighted. So in terms of thinking about the direction of bias there, if there is bias, it would move towards making the coefficient positive or insignificant. So the fact that we find a negative and significant coefficient would mean that despite if there is an endogeneity bias, then despite that bias, we are finding, the results that we are finding. So in the worst case scenario, one can think of the quantitative magnitudes that we find as a lower bound estimate on what the impact of these controls could be. And yes, if there is an endogeneity bias, and if we are able to control for it appropriately, then the quantitative impacts could actually be higher than what we see. And then we completely, take your point on the propensity score matching, and that's something that we would look into more carefully. On the second point about the capital outflow promoting measures, so we look at all controls that are targeted on non-resident flows, so both non-resident inflows and non-resident outflows. So if there's, for instance, an easing of control that is, targeted on non-resident outflows, that would be in the measures that we have. But I think you also raised an issue about controls on resident outflows, and so that's something that we don't have in the paper, and I think we feel that it's okay to have it that way, because our left-hand side variable is also all about non-resident flows. So we're not looking at net flows in the country. We're not looking at non-resident flows minus resident flows, which would be the net inflows. If we go in that route, then yes, we have to control for the resident restrictions, both on resident inflows and resident outflows as well. And I think, on the third dimension, there are some papers which have sort of tried to look at this intensity dimension of controls, but then you have to, focus on a subset of measures. So for instance, if you just focus on the price-based measures where you have taxes and unremunerated reserve requirements, you could come up with a measure of the intensity of controls. But then if you're looking at all type of instruments, then it really becomes very difficult to compare the intensity. And I think the other issue that becomes problematic is not just whether it's a 1% tax versus 10% tax, but also, what subset of transaction is that applied to? So for instance, if it's a 10% tax, but it only affects, say, 2% of the flow coming into the country, in a grand scheme of things, that might not be important. But yeah, we take that point completely. And if nothing, I think this should be, clear as a caveat that this is a shortcoming in the literature and something to think more about. But again, thank you so much for all the comments.
Thank you very much. Any questions and comments from floors or online participants? I have actually one or maybe more, but I kind of remember in a sense around 2010 there was a big change at the IMF. Before that, capital accounts should be liberalized, and after that, given the crisis episode, especially global financial crisis, people start talk about. I think two. One is very minor, more typical restriction even before it existed, which is a capital outflow restriction when the crisis hit. That people, if there's a capital flight movement, so that some countries try to restrict the capital flight to other countries. That's kind of understandable there. The second issue is before the crisis, there is indeed a boom, so that they somehow try to curb the surge of capital flows. That is a kind of new idea at that time in the name of macroprudential policy. But in any case, that's a crisis kind of policy against the crisis. And we do know the crisis happened in once a 30 years in typical countries, maybe once a 10 years in Argentina or some specific countries, but usually it's not really happening every year, right? So that means that also I do remember those. That means this kind of capital macroprudential capital control should be short-lived in a sense. should be temporary rather than permanent policy, I believe. So that the question is, from the viewpoint of that kind of crisis policy-minded view, I believe it's probably better to look at what the duration of those capital controls that countries installed and how it kind of there, how long it is there. Because if it's too long, there may be a much larger side effect. The side effect, I mean that in a usual normal period, we still don't see much reason to have a capital control. It is about more crisis-related measures. That's my sense. And secondly, even in a crisis time or before the crisis time, I think 2010 or 2011 institutional paper, I think, point out capital controls is still a very possibly have a big side effect. So that should be adopted only after other policies are kind of exhausted, monetary policy or fiscal policy exhausted. In that sense, those policies need to be somehow controlled somewhere, I believe, in your profit or some regulations. And then third issue on the side effect, it is also you are kind of in a sense, your side effect showing in the end is that if maybe capital control for one country is maybe a good thing, but if it's spilling over all the countries have a tighter capital control, we lose international capital market in a sense. That's bad for all the world economy. And that point, I think, should be the last, probably the second or the next paper of you or all of here sitting here. But that, I think, is important point because we all know this Becker-Geneva policy is not good if each country adopting those things as a kind of retaliation or just a reaction to the other countries' movement. Anyway, if you have any comments, sorry.
Yeah, no, thank you. And I think, these are all sort of valid issues. I think on your first issue about whether or not capital controls are more of a crisis based measure. So I think there are two things. So if you sort of go back in the history and if you look at capital controls which are introduced during periods of crisis, you actually do find that they are really sticky. They might be, introduced with the intention of being temporary, but in most cases, they end up staying there for 10, 20 years. So I think then the idea of preventive or, preventative capital controls in some sense is one where they can actually be temporary, because then you're saying you build, defenses right now so that you don't end up in a situation where you have to undertake controls which can be, persistent for a long period of time. I think views in general about the use of these CFMs or capital controls have evolved significantly. So if we look at the most recent review of the institutional view at the IMF, which was done in 2022, actually, there we say that, and again, in the context of this whole integrated policy framework, if you've heard about it, you mentioned about the other policies, so it's linked to that discussion. And I think the bottom line there is that if you have inherent vulnerabilities in the country, and vulnerabilities could be either in the form of, large stock of unhedged balance sheet mismatches, or in the form of shallow FX markets, such that your markets might not be able to absorb these large shocks, then acting preemptively may be useful. And again, it comes down to your question about temporariness as well, because alongside all these measures, you have to think about how to make the FX market more deep, how to make the balance sheets more resilient, how to allow firms, corporates, households to be able to hedge their FX exposures. So once you move towards those structural features, and as you progressively move towards that, the need for these temporary tools can then be lower. So I think in that setup, capital controls or CFMs doesn't necessarily just become a measure, for eliminating crisis. It can be to to avoid these boom bust cycles, have an additional instrument, in your policy toolkit until you reach a stage where you have your structure of the financial markets and the economy such that you'll be able to weather these shocks better. And then, and on the issue of the multilateral spillovers, yes, completely taken. I think that's an area to sort of probe more. And I think the whole sort of idea behind the institutional view in the IMF is sort of to provide a framework for that. At the end of the day, you don't want indiscriminate use of these policies, given the fact that there are costs, both in terms of, domestic long-term costs, but also all these international costs associated with the measure.
Thank you. And another one question coming from online, Sahay-san. You can show your face. Yeah, I can hear you.
Okay, thank you very much for interesting presentation. I really enjoyed it, and thank you so much for Professor Ueda-san who managed to have this conference in this intractable Zoom online, worldwide, and thank you so much. But anyway, my question is simple. Just only two. I was wondering do you think the exchange rate regime is going to matter for the recipient country? Because if they are pursuing some sort of fixed exchange rate regime, then of course the inclination is to tighten the capital control when there's a surge worldwide. And then second question is that I think it's a suggestion. It's instead of just taking the GDP growth, I think it might be, I don't know, might be better to look at the cycle, because EMEs do not want pro-cyclical capital inflow. Perhaps if you take out HP filter or whatever the fancy filter that you use that to see if this economy is boom or in a down, then that can be adding something. And I also finally I have a small question. What is the risk index that you mentioned during your presentation? Maybe I missed something, but where can I get that index? Thank you.
Thank you for the questions. And I think on the first point about the exchange rate regime, absolutely it does matter. As you said, if you're in a fixed exchange rate regime, you don't have an option but to either use FX interventions or use capital controls to defend the value of your exchange rate. So in the sample that we look at, we are looking at flexible exchange rate countries, which most of them have IT, because in countries which don't have flexible exchange rate regime, I think this is not a policy instrument. It's just a tool to keep the exchange rate fixed. I think on the GDP growth, if I understand correctly, you mean so we have it as a demand pull factor where we use GDP differential from the US, and your suggestion is to also look at the cyclical position of the country instead. Yeah, I think that's a good suggestion, and we'll explore that further. On the risk index, so it's a composite, it's a political, financial, economic risk rating for a country. It comes from Political Risk Service. If you go to their website, they have a rating and an index for a wide range of countries, covering these three aspects: political, financial, and economic risk.
Thank you so much. Thank you so much for the presentation.
Thank you.
Thank you very much.